Welcome to South Dakota. Behind me is what freedom looks like. I saw some bison yesterday roaming free, and it reminded me that financial freedom is very similar to what the bison experience. They're nomads, like I am. So today I want to talk a little bit about financial advisors and why you should absolutely stay away from financial advisors as much as you can. So I've been on the institutional side of investing for over 35 years. As I mentioned before, I have an Ivy League MBA. I started my career at Salomon Brothers, which was eventually bought by Citicorp. They were the number one bond traders in the world. And I have an appreciation for what financial advisors know and what they don't know. Now, this is just my opinion, so you can do with it what you want. But in my view, there's a number of problems in that retail financial advisor industry. First of all, and I don't want to be too harsh, but most of these guys are idiots. They really are. You don't need to graduate from high school to be a financial advisor. And they keep on reinventing themselves with these new terms. When I joined Wall Street, they used to be called brokers, and ones that used to deal with richer people used to be called high net worth salespeople. Then they took on these new titles like fee-only advisors, and I think now they call themselves wealth managers. But they basically don't know what they're talking about. And the worst thing you can do if you want early financial freedom is to rely on a financial advisor. They know very, very little about the mathematics of finance, which is what you really need to know about. Now, in my career, I developed products as an investment banker and derivatives trader for the big boys, for the hedge funds, for the pension plans. I had clients like Nomura Securities, the largest investment bank in Japan, BlackRock, Julian Robertson's firm, which was one of the first hedge funds in the world. It was a quant hedge fund. So when I see financial advisors dealing with individual people, the question I ask is, why are people getting such a low level of advice? And it's not what you think. So amongst these scams, I love the fee-only advisor scam. So in the past, you would pay commission, perhaps a big commission. But if you're a buy and hold investor, you have a time horizon of 40 years if it's an investment account. That's not such a bad deal. You buy it, you hold it, you retire in 40 years. But now with the fee-only advisors, what they don't tell you is because you're paying them a fee, you're going to underperform just buying an index and keeping it, whether the market goes up or down. So let's just take this example. Your fee-only advisor charges 1%. So let's just say the S&P 500, which is a particular index, goes up 10%. Well, you're not going to get 10%. You're going to get 10% minus the management fee, which is 9%. Now, let's say the reverse happens. The market goes down 10%. Well, you're not going to just have your assets go down 10%. They're going to go down 11% because your advisor is still going to get paid. Now, explain to me how that makes any sense whatsoever. So my advice on this channel has always been, think critically, don't trust anybody. If you do trust somebody, ask them these questions. Do you have an Ivy League MBA, and did you get trained in the institutional side of one of the best investment banks, the top investment banks, Salomon Brothers, Morgan Stanley, Goldman Sachs, that kind of thing. And I think most of the time they will say no, because guys like me don't advise individuals. We advise hedge funds and governments and pension plans. So that's okay, because you might think you don't know anything about finance, but in reality what you have is common sense, and that's all you really need. And part of common sense is to understand the different conflicts of interest people have. So if I'm going to be a fee-only advisor, my incentive would be to charge a lot of fees and not particularly care where I invested the money in a bull market, because everything goes up in a bull market, and I get my fee. So you got to understand that conflict of interest. Take FINRA. So FINRA is a regulatory body for these so-called advisors. And FINRA is actually not a government body. They're supervised by the SEC, which is a government body, but they're not a government body. In fact, they are paid for by the broker-dealers they supervise. I want you to think about that. What industry do you know that supervises itself? In the pharmaceutical industry, you have the FDA, which regulates pharma companies. Well, the FDA is part of the government. They have salaries. There's no conflict of interest there. But in FINRA's case, since FINRA is a private organization that regulates broker and dealers and wealth advisors, they will not side with you if you get into an arbitration conflict. If you want to sue them, basically, the contracts that you sign when you go with the broker-dealer all say you have to go to arbitration, which means you have to go to a private mediator. Now, to top it off, guess who that private intermediator is? It's a person from FINRA with two so-called individuals that are outside of FINRA. But the guy who knows what he's doing, or the gal who knows what they're doing, is from FINRA. So you're suing FINRA or the broker-dealer, but the person deciding it is FINRA. And then, when you go to appeal that first round of arbitration, guess who's there? Two members of a broker-dealer. So if you're suing a broker-dealer, you have FINRA, which is paid for by the broker-dealers. And then, even if you appeal it, you have broker-dealers determining what happens to you. What do you think the chances are that you're going to win against FINRA or a broker? Not very high. Conflict of interest. So let me tell you where you don't have a conflict of interest. You need to do your own capital allocation. Now, what I've talked about on this channel is buying strips of cash flow. Now, what do I mean by that? What I mean by that is essentially buying loans. Now, there's different kinds of loans. There's bonds, which you can buy on the market. There's senior secured bank loans. There's floating rate loans. There's preferred securities. There's all kinds of structures where basically you become the lender. And that's why it's passive. Now, there are certain structures that, how do I put this? There are certain structures that will give you a perpetual cash flow. That is to say, they never end. They never stop giving you interest rate income. But there are other structures that are a lot simpler where you can just roll it over. I mean, a very simple exam is a certificate of deposit at a bank. What you're doing when you're buying a certificate of a deposit, you're actually loaning the bank money, and that's why they pay you interest. Now, I remember when I first started off with investing when I was in my teenage years. The first thing I did was I started with CDs, and that's where I drew my love of lending, if you will. Strips of cash flows. That's what lending is. You receive income. And what I used to do is take a 30-day CD, and I would just roll it over and over again. Well, that's perpetual because it renews itself. Likewise, a 5-year bond gets renewed and renewed and renewed. If you have an endowment or a trust fund, you can tell the administrator to just renew these bonds. And that's where the action is, because if you have a diversified portfolio across different industries, across different levels of the capital structure, you're basically not subject. Sorry about that. That's a person in South Dakota on their motorcycle experiencing freedom, I guess. If you roll over your loans, you are not subject to price moves, right? So the stock market can go up and down. It doesn't matter. Okay? I don't like stocks. And I don't like stocks because the people who run the companies know more than you do. So if they're selling, why are you buying? You have an informational disadvantage when you're playing the stock market. But when you're in the bond market, when you're in the what I'll call the loan market, you don't have an informational disadvantage. There is some credit risk, but you don't have price risk. Why is that? It's because if it's a 5-year loan, you'll get your principal back at the end of 5 years. If the 5-year bond, you'll get your principal back in 5 years. So the worst case scenario is you get the interest rate that's in the coupon, but you don't lose money on it. Now, I'm not saying you'll never lose money because there could be defaults. But if you know how to price risk, and you can teach yourself that, just like you can teach yourself conflicts of interest, that's a much better way to achieve early financial independence. And again, the key is early financial independence. That's why I don't like retirement funds. Because if your goal is to retire by 30, then having a structure that penalizes you from taking capital out before you're 59 and a half doesn't really make a ton of sense, does it? I have a friend, let's just call him Sanjay. He's one of these guys that he has a PhD in chemistry, but he thinks he understands everything, including finance. And he has a daughter who's like 30 years old, lives with him. And I said to him, what the hell is she doing living at home? She works in New York City in a bank. And he said, well, she's saving up for a home. And I said, why the hell would she be saving up for a home? What she wants to do when she's 30 is have complete variable costs by renting. And in 24 hours, be on a plane to wherever she can make the most money. Because the way you accrue capital is through maximizing revenue and minimizing cost. So if she goes to Hong Kong, maybe she'll get an expat package, so she doesn't have to pay for her home. And Hong Kong is cheaper, so she'll be able to save more money. If the opportunity's in Dubai, if the opportunity's in India is the fastest growing economy in the world. I met a guy down there who's in his, I think he's in his 20s, late 20s, an American guy, an Anglo-Saxon guy. He went there and started a burrito business, and they're doing $37 million a year now in burritos, and he's franchising them. Well, you know, he went where the growth is, and he made it happen. So that's what you should be doing when you're 30. You shouldn't be buying houses. You should be renting and maximizing your revenue. But that's not what people will tell you. Why is that? Because middle-class people become middle-class by listening to other middle-class people. Now, when I say this, I'm not saying it in a pejorative or snobbish way. I'm saying it as an economist. I've defined in previous videos what middle class is. Middle class is intellectual labor being exchanged for cash flow. And what you want to do is become a member of the investor class so that you don't have to exchange any kind of labor, manual or intellectual, for cash flow. You just have leisure. And the premise that I've made throughout these videos is that, on this channel, is that the object is to look at socioeconomics, which is 3 variables: education, culture, and capital. So you build a capital to be financially independent, then you pursue education and culture. That's the way it was done when you had the older aristocrats, landed gentry, and I call that leisure class, that investor class, the aristocratic investor class, because they achieve financial freedom and then use that leisure to pursue education and capital. So living in your home is what middle class people do, and they stay middle class because then they get a 36-year mortgage, and then they have to retire at 65 instead of 31 because they have to pay off their mortgage. Well, how about you rent and have that flexibility and move wherever the heck you need to move in order to maximize revenue and minimize cost. Now, you're not going to hear that from your broker. You're not going to hear that from your wealth manager. And the reason is because they don't have an incentive to tell you that. They don't make any money telling you that. Your real estate sales guy is not going to tell you, just rent, don't buy. Nobody's looking out for you but you. And critical thinking is all you need. And you have the essence of critical thinking, which is logic and common sense. So the message for today is, if you want to achieve financial freedom early, financial independence, which I think should be the goal, not owning a house, but financial independence. If you want to achieve it early, get the hell away from financial advisors. Buy strips of cash flow, and once the cash flow is multiples of your cost structure, you're financially independent, knock yourself out. Go to South Dakota. I was where was I? I was in Calcutta last week. A couple of weeks before that, I was in Bolivia. You know, that's what freedom looks like. And you can do that only when you have financial independence. So with that, I'll say goodbye. Who knows where I'll be talking to you from next. Take care.